Sunday, May 17th, 08:58 a.m. New York time. Welcome back, investors, to Winning Wall Street's Money. It's going to be an update on bonds, yields, interest rates. Big changes occurred the past few days. Give you some insight. There's different bonds. Some people may not aware. So I'll give you market basic, what most financial education systems don't do a good job educating the consumer, the public. I'll break it down even easier. There are many people very good in their job, and they're lousy in communicating. You might have a person that's great in IT. They're lousy in communicating. You might have a great teacher in the knowledge of history, math, or science. They're lousy in communicating. Do you know anybody like that? I've come across many people like that. So I took up the initiative, owned up, and went on my own to learn many subjects. There's a bigger learning curve. The broad market. The bond market is one of many different financial assets. The bond market is fixed income, CDs, fixed income. There's different categories of bonds, okay? There's municipality bonds for your city and county. If they need to build bridges, roads, highways, and they don't have enough cash on hand, they may not want to raise taxes, so they'll create bonds and sell those bonds. And those bonds get letter grade ratings. And that's based on what their value is, what interest rates they're going to pay, which is interest rates, aka yields. You also have state bonds. And then you got the U.S. Treasury Department that funds the U.S. deficit because the U.S. spends more money than they collect in taxes. I'll say that again. The U.S. government spends more money than they collect in taxes. So they need money to pay that debt. And they sell U.S. Treasuries. And I will show you those U.S. Treasuries. You could buy U.S. Treasuries. There's different durations. So when the yields go higher, the new yields go higher, you could earn more interest on the new yields, the new bonds. Again, when interest rates go higher, the new bonds pay higher. Not so good for the people that bought the older bonds that are tied into those. They won't be keeping up with inflation necessary. Yeah, so you got municipality bonds, like I said, city, county, state. And then you got the federal government, U.S. Treasury bonds, where you also have corporate bonds. Some corporations, they may not want to issue more stock shares, aka equity, because they don't want to give up more ownership of the company. Some companies talk to bankers, and the banker terms, those companies didn't like, so they didn't borrow money from banks. Instead, they issue bonds. There's some companies that are Fortune 500 companies. There's some companies that are smaller. Those bonds also get letter grade ratings, and that will help determine the yields on those bonds, what the interest rates are, and the duration. There are ones that are from 1 month, 2 months, 3 months, 6 months, 5 years, 10 years, 30 years. Got it? Different terms, durations. Well, situation where you might be buying a bond from Google or Verizon. Maybe you're buying a 10-year bond from them. Some of them had spelled out in the agreements that they could take those away from you before the 10 years is up. You still earn money for the duration you're in it, but you won't earn that full face value because that's their agreement. So again, don't responsibility, check and verify. Give you an example. You might have some company offering a 7% interest rate for a 5-year bond, paying out minimum dollar amount. Maybe they say the minimum you have to purchase is $10,000. And you might say, wow, 7%, $10,000 for purchase, higher than these municipalities and governments. What's the risk? Well, again, you can have a company go under. Remember, a company doesn't print money. They need to have performance. And then why do some of those companies want to buy back those bonds? Well, again, they might have fixed their problem that they originally needed to borrow money from, Instead of waiting 10 years, they might have fixed it in 3 months, 3 years, 5 years. There's also other countries that offer bonds. Maybe you want to check out the ones in, if they offer them, North Korea, China, Cuba. Maybe they're offering higher interest rates. How credible are those countries? What letter grade you think they're getting from the regulatory agencies, the for-profit regulatory agencies, such as Moody's, S&P? So let's go a little bit more now. We'll look at the U.S. Treasury market, where they sell, again, bonds and notes. And also the corporate the muni. Those are on the bond markets too. But I'm specifically going to share the U.S. Treasury ones. Which again, the bond markets, you could also go to the trades in the futures markets. There's future bits. Let's stick on subject. So here we're looking at the variety of different durations. Top left, the 30-year bond. The top right, the 10-year bond. The bottom left, the 5-year notes. And the bottom right, the 2-year note. So again, these are each 5 years of history. The difference is between a bond and a note is duration. If it's 10 years or longer, it's a bond. If it's less than 10 years, it's a note. And then there's ones, if they're less than 1 year, different names. For the U.S. Treasuries, I'm not talking about municipalities, state, or corporate. I'm talking about U.S. Treasuries. So again, U.S. Treasury, one of the several federal agencies, U.S. Treasury, 30-year bond. Again, 5-year chart, each candle's a week. Look at the direction, the trend. It's declining. Look for the week, new low for the year. Got it? The 30-year bond, new low for the year. The 10-year bond, new low for the year. The 5-year note, new low for the year. And the 2-year note, new low for the year. So the fact is, each of these durations are making new lows for the year. These are bonds. Very basic. Again, the interest rates they pay, when yields go higher, they pay higher interest rates. So if you buy the new ones, as of Friday, they're paying higher interest rates. First, the ones that bought these early in the year, those interest rates were less. Let's go look at yields now. Again, U.S. Treasury Department. And what I'm showing you is real data directly from the exchange, but not all stockbrokers offer this information. So you may not have access to it with your broker. I do. This is the 30-year yield. Look, it's going up. So again, the 30-year yield versus the 30-year bond. Got it? So if I buy the new 30-year bond, those interest rates are higher. Those yields are higher. I'll earn more. Again, here we go. 30-year yield. 5-year chart. Each candle's a week. New high for the year. Yeah. 30-year yield. Yield is higher. Interest rates higher. The 10-year yield. New high for the year. 5-year yield. New high for the year. And the 2-year yield. New high for the year. At both available in my charts, I prefer to look at the yields because, again, the yields are going to determine the bonds. So again, the bonds, the instrument you purchase, but those bonds change based on the yields. So if you are speculating that you think interest rates are going to go lower, then you trade the inverse. And I will show you those too. Me, I'm speculating interest rates are going to go higher. So we just looked at the durations 30, 10, 5, 2 of the bonds, notes, yields. Now let's do some more comparison. Go to switch charts. I'll stick on the same time frame too with the 5-year and weekly. So we'll do the higher duration first, the 30-year. So on the left is the 30-year bond, and the right is the 30-year yield. Again, both durations, the charts are 5 years, the candlesticks weekly, and the financial instrument on the left, 30-year bond, and the right 30-year yield. So you see they go in reverse. The bonds declining, the yield's going higher, higher yield, higher interest rates. That's the 30-year. Do you want to be invested in a 30-year financial instrument? Some people want to be at a shorter duration. Let's go look at the shorter duration. Go down to the 10. Again, each grid is 5 years. The left is the 10-year bond, and we already saw a new low for the year. And the right is the 10-year yield, new high for the year. So that's the comparison between them. Some very basic, again. And these trade in the futures market. Since they trade in the futures markets, if I have access to a broker that trades futures, I could trade these day trade, swing trading. I don't have to be tied up in them for 10, 20, 30 years. I could day trade them, swing trade them, and invest them. That's the opportunity in a capitalism free market society. You can risk your own capital. Make a lot or lose a lot. Let's continue now on to the next. We'll go look at the stock ETFs. So again, you may not have a futures account, but maybe you want to trade these if you have a stockbroker account. Let me queue up the stock. And again, we'll do the higher duration first. Oops, wrong one. Go down to the stocks. Nope, actually, I want to show you the futures compared to the stock. Yeah. Let's go back to the futures. There we go. So the left is the 30-year yield futures. Again, we know the 30-year futures made a new high for the year. I'll zoom in a little bit more on the left. And there's stock ETFs. On the right is the stock ETF. You don't need margins to trade these stock ETFs unless you're going to short them. Got it? So again, the 30-year yield on the left is going higher. And the stock ETF, TBT, going higher. This company that manages this stock ETF trades the futures. So now you don't have to have a futures account to trade them. Again, there's a difference in the duration, the hours you could trade, and the margins. Remember, I told you the bonds trade inverse from the yields. Bonds go lower, then yields go higher. That's why this is called the ultra short, because you're shorting the bonds by buying the yields. But again, you don't have to have margin because you're not trading it in the futures. You just simply buy the stock. When the yield goes higher, the stock goes higher. The name of it's not going to change. And it closed here at $37.42. If you want to buy the stock share, that's what the last trade was. If you don't want to spend $37.42, you can spend $5. You can spend $10 using fractional shares if your broker lets you trade fractional shares. So maybe I want to dollar cost average. Maybe every week or every month, or every 3 months, I want to contribute $300 or $100. I could do fractional shares. I put on $100 and I'm going to buy $100 worth of fractional shares instead of buying a single share. And if the price goes continue up, again, my investment of those fractional shares are going up. Day trade, swing trade, vest. Not all brokers offer fractional shares. Each broker that does offer fractional shares, they have a specific list of what stocks they let you trade. Not all brokers offer the same stocks on fractional shares and different fees. I have different brokers that give me access to different stocks for fractional shares, and they have different policies on how much the minimum is to trade in dollar amount invest. Because I haven't found one solid stockbroker that lets me have the opportunity for fractional shares of all stocks. It's kind of like mutual funds. You might be doing contribution through your IRA, 401k, or some investment portfolio. Maybe you're putting $500 a month or $5,000 a month in your investment portfolio that's buying mutual funds. And you, again, putting $5,000 a month, $500 a month, you peg a dollar amount in your investing instead of how many shares of mutual funds you want to buy every month. You're going to be putting that same dollar amount, dollar cost average. It's a good, solid plan, dollar cost average for investing. All right, let's go now. Here's something else. Again, that was the TBT. On to the next. Again, this is bullish. If you're speculating yields are going to go higher, interest rates go higher, this is the stock ETF to buy. Me, I personally would want to check and verify during regular trading hours, the spread, the liquidity, see if it's a solid equity to want to do. I have certain money managements I require when I select stocks, regardless if I'm trading the options on them or not. So again, on the left, it's a 30-year yield. Same thing we just saw. Again, yields going higher. On the right is a stock ETF called TLT. It's trading down. Yep. So if the yields on the left were going lower, then the TLT bond would be going higher. So again, if you're bearish and think the yields are going to go lower, well, you'll be buying the TLT. If you're dead set in believing whatever politicians you're listening to or business media that the interest rates are going to go lower tomorrow, next week, next month, or maybe you want to speculate, put money in what you're talking about. So again, if you think interest rates are going lower, then you would want to be buying this. But interest rates have been going higher. That's why this is declining. Again, it has options on it too you could trade. So since we saw in the futures market, the chart for the bonds and the yields, again, how they were trading differently, let's go look at the stock ETFs. Compared to each other. So each chart's 5 years, each candle is weekly. So on the left is the T-bill TBT, and on the left is TBT, and the right TLT. Both stock ETFs. Again, the left is the short bonds. So again, the bonds going lower, the yield's going higher. So this on the left is correlated for the bullish, higher yields, lower bonds. And if you are bullish bonds and thinking yield's going to go higher, if you are bullish bonds and think yield's going to go lower, you could be buying this and you'd be wrong because they're going the inverse. So again, two stock ETFs, and however you want to speculate and risk your capital. Your opinion doesn't matter in the stock market. Your opinion doesn't matter in the currency, the bond market. But charts don't lie. So you continue using what's solid, you think is solid, to determine speculation. At the end of the day, I hope you use good money management. If you're wrong, own up and get out of that financial instrument. All right, let's continue. Looking at some good, solid information I just showed you on the opportunities. What I want to show you now is some stuff that helps determine the yields going higher. Here we're looking at the top left, U.S. national debt. It's over $39 trillion. Yep, it's been rising. Again, I told you the U.S. government earns less money from tax revenue, so it has to sell paper. Again, when you hear people say paper, bonds, notes, that's paper. Currencies, commodities, stocks, those have different names. But again, when you hear people doing the paper, that's referring to the bonds, the notes. So again, the United States spends more money than it takes in tax revenue. So it sells those U.S. treasuries. Again, we're only paying interest on the U.S. debt. That's disgusting. Yep. And it's breaking all-time records. The FOMC meetings. I'm going to go over those. So again, FOMC, because some people apparently that I know that work in federal government agencies that have college degrees in different academics were not taught nor took the initiative to learn on their own. Federal Open Market Committee, the FOMC. That's when the Federal Reserve has scheduled dates to meet, to vote on short-term interest rates. We just had one occur recently. Yep. So here we go. This is the futures markets on the Futures Exchange CME group. In this page right here, on the top left, I'm looking at 17 June. That's the next FOMC meeting. The Fed has a target rate. Current target rate, 350 to 375. So in the 17 June, they're speculating right now. Traders speculating. 98.7% are speculating the Fed will leave rates unchanged. And again, this would change during regular trading hours. So if you think, in your opinion, whatever your news sources, your research those, if you think the rates are going to go lower, I showed you what you could put your money towards. And then there's another FOMC meeting on 29 July. There's a change here. 94.6% think rates would be left unchanged. But look what here, a tick up. Some people are speculating now the Fed may raise interest rates. Let's go 16 September. So 81.2% speculating rates would be left unchanged 16 September. But more people increasing, 17.1 now speculating that the Fed will raise interest rates. There's an FOMC meeting in 28 October. Wow, look at that. Now it's a big difference. Only 67% are speculating rates would be left unchanged at the 28 October meeting. Increase of people speculating rates would be raised between 3.75 and 4. And here, another increase showing now here. 3.5 are speculating again. So again, less people are speculating the rates would be left unchanged and more are jumping ship and going over here. Speculating rates would be raised. There is no FOM scheduled meeting for November. Again, the Fed can hold meeting anytime they want, but there's no scheduled as of right now for November. But what does happen in the United States in November is the general election. The general election. And then the last one scheduled this year, 9 December. Less than 50% of the market speculating rates will be left unchanged. There's an increase now for that December, over 39.1 now. And if you add this one here too, again, the increase, more people are speculating after the elections. Next FOMC meeting, rates will be raised. Higher rates, higher yields, higher interest rates. Again, I told you U.S. debt is only being paid the interest on there. That means more tax revenue being collected. It's just paying the debt to fund the government. Let's go look some deeper now. This is U.S. Treasury. You could create an account here and buy U.S. Treasuries. I showed you 30, the 10, the 5, and many more. You don't have to go to your bank. You don't have to go to your broker to buy fixed income paper. You can buy them straight from the U.S. Treasury. You have an email account. You have a phone. You have a password on your phone. You have a password on your email. So you know how to do that. You could create an account here on U.S. Treasury. So for the year 2026, show you some basic stuff. Again, the business days. Again, the U.S. Treasury Department trades, sells our products during regular business hours. And of course, they would close on New Year's Day, so they had to open the second day, January 2nd. So the shorter duration, see there's a 1 month, 1.5, 1.5 month. I want to show you the shorter duration has lower yields, lower interest rates. But let's go straight to the 1 year. The 1 year, as of January 2nd, the 1 year U.S. Treasury was paying 3.47. 3.47. Go to the 10 year, it was paying 4.19. And the 30 year, 4.86. So again, the higher duration, the longer you're locked in, the higher interest they pay. That was just a few months ago. Let's go currently. Go to the current month. In the current month, we're going to go to what was the close of Friday. The bottom left was the close of Friday. And we'll go to the 1 year on the bottom, 382. It paid more. So again, if you bought the 1 year Treasury on the first trading day of this year, you were paying 3.47. But if your dollar cost average, remember that key word I said, dollar cost average. So if you buy another one, had bought another one on Friday, you'd be earning more. And maybe you have a one that you had bought last year or a few months ago that's expiring Monday, or you can roll into the higher one, earn higher interest. Let's go to the 10-year category right here, the 10-year category. Friday, the 10-year U.S. Treasury closed at 4.59. So that's actually lower because the January 2nd, it was 4.81. Now let's go to the 30 year. The 30 year, 5.112. That's higher. Again, January 2nd, the 30 year was 4.86. I'll show you here again. Left side date, January 2nd, the 30 year was 4.86. Let's go to the current month. As of Friday, 5.12. So again, if you bought the 30 year on January 2nd, it was paying 4.86. Past Friday, paying higher. Again, you could earn more income on the yields investing on the past Friday versus January 1st. Yep, more tax revenue is paying interest rates because higher interest rates convince people to buy U.S. debt to fund the deficit, the increase of spending. Let's go look at credit cards. Sorry, mortgages. So as of Friday, the 30-year fixed mortgage closed at 6.65. That increased. Yep. So if you just got a refinanced or new 30-year mortgage, you're paying higher interest. And I'll give you some insight. So many people are misinformed because they choose not to do solid research. If the Federal Reserve lowers interest rates, that doesn't mean the price of a car is going to decline. That doesn't mean that doesn't mean a house is going to mark down their price or a new construction builder is going to mark down their price. Totally two different things. So again, if the Federal Reserve was to lower short-term interest rates, that doesn't mean the value of the house is going to sell for less. And if your income is not going up, that doesn't mean you're going to be approved, even though your credit might be meeting the guidelines. But again, many media are misinforming people on that. Yep. So here on the 15-year, close at 16, 6.10, and that went higher. And then you have the other ones here on the left. So if the yields continue going higher, expect these to go higher. Again, there's a shortage of housing by choice. Again, if there's bigger demand, that's going to help goose up the prices of the houses. And let's go look at credit cards now. The average credit card rate. So as the pass back on 5/13, nearly 20%, 19.57. That's high credit card interest rate. High rates. Wow. Give you some other insights. U.S. stock market, aka equity, different stock indexes. There's a small stock index called the Russell 2000. When I say small, comparing that to the S&P 500. The S&P 500 has companies that are worth hundreds of billions of dollars. They have a lot of cash. Then there's the companies on the Russell 2000 stock index. Some of them don't have a lot of cash, and they fall to terms of banks to borrow money. Banks raise interest rates. It impacts them much more. So there are some companies that can survive better and longer when the economy is not the best, such as now the economy is not the best. Don't be surprised when you see more businesses on the stock index, their values decline, their share prices decline. And then some of them be through mergers, acquisitions. Some of them get kicked out of certain stock indexes, stock exchanges, because they don't meet the requirement to maintain on those stock markets, and they go to other stock markets. Yep, there are several stock markets. You also have defaults, bankruptcies, and I've been showing those on other videos, how those have been increasing. But I just showed you the opportunity to earn income on bonds, aka yields. You could do that with stocks and options. Thank you as always spending just a little time with me. That's it for the video. Thank you kindly for watching.